Hey everybody, welcome back. I hope you had a great weekend. Today we're talking about how index funds reshaped global finance. If you looked at the financial world in 1975, you would see something radically different than you see today. Stock picking was the norm. The top fund managers were treated like celebrities, and the idea of investing in a fund that didn't even try to beat the market, that was considered laughable to most. Yet, over the next few decades, that exact idea would go on to quietly reshape global finance. In walks the humble index fund. No hype, no flashy stock tips, just low-cost, rules-based exposure to the market itself. So today, I want to break down what index funds are, how they work, the different types that exist, how they came to be, and just how dominant they've become. And along the way, we'll talk about some of the implications, the good, the bad, and the misunderstood. But before we dive in, if you find any of this helpful or insightful, hit that like button and subscribe below. It really helps out the channel. So let's start with how these things came to be. Well, in 1975, Jack Bogle, who was the founder of Vanguard, he launched something called the First Index Investment Trust. It was built to track the S&P 500, and it was pretty underappreciated from day one. Now, the idea was simple. Instead of trying to pick winners, just own the entire market. Wall Street called it Bogle's folly. They couldn't imagine anyone who would want a product that didn't even try to beat the market. But Bogle wasn't guessing here. He was reading the economic data. Academic research at the time, especially from economists like Eugene Fama, was showing that the most actively managed funds failed to consistently outperform the market, especially after fees are taken into consideration. So what was the implication of this? Well, for the average investor, the best bet was just to ride the market average, and that's exactly what index funds do. So to understand a little bit more about what these are, an index fund is a type of mutual fund or ETF that passively replicates the performance of a specific market index. This could be the S&P 500, the total US stock market, international stocks, even bonds. And it works like this. The fund manager buys all or most of the assets in an index in the same proportion as the index itself. There's no forecasting, no fundamental analysis, just replicating. The benefit of this is for the investor, that means lower costs, like way lower. For example, Vanguard's total stock market ETF has an expense ratio of 0.03%. That means for every $10,000 you invest, you pay $3 a year. Compare that to the 1 to 2% fees charged by many actively managed funds, and you can see that the difference is pretty significant. Because index funds don't trade often, they also tend to be more tax efficient. Less turnover means fewer capital gains distributions, and the result of that is more of your money stays invested. And while equity index funds tend to be the ones you hear the most about, the universe is actually much bigger than that. You have bond index funds that track fixed income markets, international funds that give you exposure to global equities, sector-specific funds like technology or healthcare indexes, and even thematic or smart beta funds that tilt towards specific factors like value, momentum, or low volatility. You can even find ESG index funds that track sustainable companies or funds that exclude things like fossil fuels or weapons manufacturers. Now, those come with some controversies of their own, but we're going to save that for another video. And then there's the structure of an index fund, a mutual fund versus an ETF. Well, mutual funds and ETFs do basically the same thing, but ETFs trade a little bit more like stocks. That gives them more flexibility and tax efficiency. Today, ETFs have become the preferred vehicle for many retail and institutional investors. As of 2023, ETFs made up more than half of all index fund assets in the US. Now let's talk about how indexing took over the world, because here's where it gets interesting. In 1995, index funds had about $100 billion under management. Today, over $12 trillion globally, with Vanguard, BlackRock, and State Street controlling the majority of that. And in 2019, passive investing officially overtook active in total US equity fund assets. This is a massive shift in how capital gets allocated in the US. Index funds are now the default option in retirement plans, IRAs, and target date funds. Institutions use them, robo-advisors use them. I'm sure you've even heard people like Warren Buffett talk about them. The pitch is hard to beat. Broad diversification, ultra-low fees, and long-term performance that typically beats 80% or more of active funds. But with all of that success comes some new questions. Index funds now own massive chunks of corporate America. Those same companies, Vanguard, BlackRock, State Street, combined they own more than 20% of the average S&P 500 company. Now that kind of ownership raises concerns about corporate governance. If a few companies own everything, it's kind of up to them to vote on CEO pay or climate policy, and maybe not the broader shareholder base. And then there's the question of market efficiency. Critics argue that if too much money flows into passive funds, markets might stop reflecting true value, prices might become distorted, and liquidity could dry up in a crisis. But supporters counter that indexing still makes up a minority of global market volume and that active investors still set prices at the margin. Both sides are probably right to some degree. But we're entering a time where indexing isn't just accepted by everybody. It's starting to be scrutinized. The SEC is looking more closely at how the big asset managers vote on shareholder proposals. There's also growing political debate about whether index giants have too much influence over public companies. At the same time, index funds themselves are evolving. There are now index funds for private markets, crypto, real assets, even alternative database strategies. And the rise of direct indexing is letting individual investors customize their own indexes. The point is, indexing is no longer a blunt instrument. It's become more tailored, more intelligent, and more nuanced. But the core idea remains unchanged: low cost, broad-based, rules-based investing. However, there is one last point worth considering here. We've talked about this a little bit in a previous video, but when everybody is passively investing, what happens to the index itself over the long run? Well, in theory, diversification protects investors from company-specific risk. But in practice, indices can become dominated by just a few stocks. Look at what happened in Canada in the late 1990s. The Toronto Stock Exchange became heavily concentrated with one company. That meant anyone investing passively in that index, especially through retirement accounts, had unknowingly placed a massive bet on one company. And when the company collapsed, so did the retirement accounts of countless Canadians. Today, I would argue that the S&P 500 faces a similar concentration risk because the so-called Magnificent Seven makes up a huge percentage of the index. If one or two of these giants stumble outside of just normal macroeconomic events, passive investors will feel it, regardless of their intentions. And because index funds buy more of a stock as it gets more valuable, success can create a feedback loop that pushes concentration even higher. So while indexing has democratized investing and reduced cost, it's not immune to structural risk. Even passive investors need to understand what they own and what they're exposed to. But there's no such thing as a perfect investment. Everything carries risk and, ideally, a proportional reward. So to wrap this up, one of my favorite quotes from Jack Bogle is, "Don't look for the needle in the haystack, just buy the haystack." That's what millions of people are doing. What started as an experiment in the 1970s has become the default approach for long-term investors all across the world. It's not the most exciting and it doesn't make a lot of headlines. It's not going to turn $1,000 into $1 million overnight. But in the long run, indexing has quietly helped build more people wealth than almost any other financial innovation. As always, talk to a trusted financial professional before making any investment decisions. And if you found this video helpful, please like and subscribe. It means the world to me. And until next time, have a good one.